Imagine waking up tomorrow morning, pouring your coffee, opening your phone, and checking your bank account like you've done thousands of times before. Only this time, something feels different. A message appears at the top of your banking app. It says that due to temporary financial stability measures, withdrawals are now limited. ATMs are capped. Online transfers are paused. Large withdrawals require special approval. At first, it feels like a mistake, a glitch. You refresh the app. The message is still there. You try to move money to another account. The transfer fails. You try again. Still nothing. Suddenly, that quiet sense of security you've always felt about the money you spent decades saving begins to shift because the number on the screen is still there, but access to it is not. And in that moment, one uncomfortable question starts to form. What if the money you thought was always available suddenly isn't? Now, here's the part that surprises most people. Situations exactly like this have already happened. Not in some distant, unstable country. Not in a place with weak banks or a collapsing economy. It has happened in modern financial systems with advanced banking networks, government oversight, and strict regulations. Ordinary people woke up one morning to discover that their savings accounts, retirement funds, and business accounts were suddenly restricted. Withdrawals limited, transfers delayed, access controlled. And by the time the news reached the public and people fully understood what was happening, the opportunity to prepare had already passed. What makes this even more unsettling is how quickly these situations can unfold. For most of modern history, financial crises moved slowly. Rumors would circulate for weeks. People would line up outside banks. Governments had time to react. Regulators could step in. But today, the entire system moves at digital speed. Money can leave a bank in seconds. Panic can spread through social media and group chats in minutes. And once confidence begins to break, events that once took months can now unfold in a matter of hours. That's why understanding how these events happen and what you should do before they ever occur has never been more important. Because when banks restrict withdrawals, the issue isn't simply market volatility or a bad week in the stock market. The real issue becomes something much more fundamental. Access. Access to your savings, access to the money you depend on for daily life, access to the financial security you spent your entire working life building. And the uncomfortable reality is that once restrictions begin, there is very little that can be done in the moment. The decisions that protect people during financial disruptions are almost always made beforehand, quietly, calmly, long before the headlines appear. That's exactly what we're going to talk about today. We're going to walk through why banks sometimes restrict withdrawals, the warning signs that appear before these situations unfold, and most importantly, the practical steps you can take now to make sure that if the financial system ever hits turbulence, you and your family are not caught off guard. Because this isn't about fear, it's about preparation. And as history has shown again and again, the people who prepare early are almost always the ones who sleep the best when uncertainty begins. Hi, I'm Olivia, and in today's video on the USA Guide, we're going to break down something that very few people in traditional financial media talk about openly, but that has happened repeatedly in modern economies around the world. Bank withdrawal restrictions and the financial stress that can lead to them. Now, before we go any further, let me be very clear about something. The purpose of this discussion isn't to scare you or suggest that a crisis is guaranteed to happen tomorrow. Financial systems are complex, and most of the time they function exactly the way they're supposed to. But history also shows us that when serious financial stress builds beneath the surface, governments and regulators sometimes respond in ways that surprise ordinary depositors. And understanding how those responses work can make a tremendous difference in how prepared someone is if disruptions ever occur. For seniors especially, this topic carries an extra layer of importance. Many people watching this have spent 30, 40, or even 50 years carefully saving and investing for retirement. Those savings represent decades of work, discipline, and planning. Protecting that security isn't just about chasing returns or following market trends. It's about understanding risks that are rarely discussed and making sure your financial foundation remains strong even during periods of uncertainty. Over the next few minutes, We're going to explore several real-world events that demonstrate how quickly financial conditions can change. We'll look at moments when governments temporarily restricted access to bank deposits. We'll examine why those decisions were made and what signals appeared before the restrictions were introduced. And then we'll walk step by step through practical actions that ordinary individuals, especially retirees and savers, can take today to reduce their vulnerability if the financial system ever experiences significant stress. Some of what you'll hear may be surprising. Much of it rarely appears in mainstream discussions about personal finance. But understanding these patterns can help you see the financial system through a clearer lens, one that focuses not just on growth and investment returns, but on resilience and security. Because in the end, the most important question isn't simply whether banks are stable today. The real question is this: if conditions ever change quickly, will you already have the knowledge and the plan needed to protect yourself? And to understand why that question matters so much, we need to start with a very simple, but often misunderstood reality about how the modern banking system actually works. To understand why withdrawal restrictions sometimes happen, we first need to talk about something that many people are never actually taught about banking. Most people assume that when they deposit money into a bank, that money simply sits there safely in a vault waiting for them whenever they want it. The reality is very different. Banks operate on what is called a fractional reserve system. When you deposit money into your account, the bank does not store the full amount in cash. Instead, it uses most of those deposits to make loans, buy government bonds, finance mortgages, and fund other investments. Only a small percentage of total deposits is kept immediately available for withdrawals at any given moment. This system has existed for centuries, and under normal circumstances, it works very well. People deposit money, banks lend it out, businesses grow, homes are financed, and the economy functions smoothly. But the entire system depends on one very fragile ingredient: confidence. As long as depositors believe their money is safe and accessible, only a small number of people withdraw funds at any one time. But if that confidence begins to break, if large numbers of people suddenly try to withdraw their money at the same time, the math stops working. Banks simply do not keep enough liquid cash to satisfy a sudden surge of withdrawals. That situation is what we call a bank run. For most of modern history, bank runs develop slowly. Rumors would spread through communities. People might hear concerns about a bank's financial health and begin lining up outside branches to withdraw their savings. Those lines might stretch down the street, sometimes lasting for days. But because the process moved slowly, governments and regulators often had time to intervene. Emergency loans could be arranged. Confidence could sometimes be restored. Today, that dynamic has changed completely. Modern bank runs no longer happen at the speed of people standing in line. They happen at the speed of smartphones. A single message posted online can spread to thousands of depositors in seconds. A rumor can circulate through investor groups, social media platforms, and encrypted messaging apps almost instantly. And when depositors become nervous today, they don't need to drive to a bank branch or stand in line for hours. They simply open an app and press a button. Billions of dollars can leave a bank electronically within minutes. This new digital reality has dramatically increased the speed at which financial stress can spread through the banking system. What once took weeks can now unfold in a single afternoon. That means regulators often have far less time to react. And when the situation becomes serious enough, governments sometimes resort to a drastic measure designed to slow the panic, restricting withdrawals. When authorities impose withdrawal limits, their stated goal is usually to stabilize the system. By limiting how quickly money can leave banks, they hope to prevent a full-scale collapse of the financial network. But from the perspective of the depositor, the person who simply wants access to their own savings, the experience can feel shocking and confusing. And if this sounds like a distant or unlikely scenario, it's worth looking at a real-world example that shocked the global financial community just a little over a decade ago. In March of 2013, the small Mediterranean nation of Cyprus suddenly became the center of one of the most dramatic banking crises in modern European history. Cyprus had two major banks that were enormous relative to the size of the country's economy. For years, These banks had invested heavily in Greek government bonds. When Greece entered its own severe debt crisis, those bonds collapsed in value. Almost overnight, the balance sheets of the Cypriot banks were devastated. The problem wasn't that the banks were having a bad quarter or experiencing temporary losses. The problem was far more serious. The banks had effectively become insolvent. The value of their assets had fallen below the amount of money depositors expected to withdraw. As the crisis escalated, international institutions, including the European Union and the International Monetary Fund, stepped in to organize a rescue package. But the terms of that rescue shocked depositors across Europe. Before any final decision was publicly announced, the Cypriot government made an extraordinary move. Banks across the country were closed entirely. Not for a day, not for a weekend. For nearly 2 weeks, the banking system simply stopped operating. People could not access their accounts. ATMs began running out of cash. Businesses struggled to pay suppliers and employees. Families suddenly found themselves unable to reach the savings they depended on for everyday expenses. When the banks finally reopened, strict withdrawal limits were imposed. Depositors were allowed to withdraw only small amounts each day. Large transfers out of the country were restricted, and in the most controversial measure of all, some depositors with large balances saw a portion of their funds seized to help recapitalize the failing banks. The lesson from Cyprus was deeply unsettling for many observers around the world. This was not a chaotic or unstable country with a weak financial system. Cyprus was a member of the European Union with modern institutions and regulatory oversight. Yet, when the banking system came under extreme stress, access to depositors' money was restricted almost immediately. And perhaps the most important thing to understand about that event is why the restrictions were introduced in the first place. They were not primarily designed to protect individual depositors. They were designed to protect the banking system itself. That distinction matters more than most people realize because when governments face a financial emergency, their first priority is often preventing a cascading collapse of banks and financial institutions. If authorities believe that unrestricted withdrawals could trigger a chain reaction of failures, they may decide that temporarily limiting access is the lesser of two difficult options. For the individuals affected, however, the result is the same. Money that once seemed instantly available suddenly becomes difficult or even impossible to access. And while many Americans assume something like that could never happen within the United States, recent events have shown just how quickly even major financial institutions can run into serious trouble. In fact, one of the most dramatic banking collapses in modern U.S. history happened not decades ago, but just recently. In March of 2023, the financial world witnessed something that few people expected to see again in the United States, a major bank collapsing almost overnight. The institution was Silicon Valley Bank, often called SVB. This wasn't a small regional lender with a handful of branches. It was the 16th largest bank in the country, holding more than $200 billion in assets and serving thousands of technology companies, venture capital firms, and startups across the United States. For years, Silicon Valley Bank had been considered a pillar of the tech financing ecosystem. But behind the scenes, a dangerous imbalance had been quietly building on its balance sheet. Like many banks during the era of extremely low interest rates in the 2010s, SVB invested a large portion of its deposits into long-term government bonds. At the time, those bonds seemed safe. Interest rates were near zero, and government securities were widely considered one of the most stable investments a bank could hold. Then something changed. Beginning in 2022, the Federal Reserve began raising interest rates at the fastest pace in more than 40 years in an effort to control rising inflation. Those rate increases had a powerful effect on the bond market. As interest rates climbed, the value of previously issued low-interest bonds dropped sharply. That meant the bonds Silicon Valley Bank had purchased when rates were near zero were suddenly worth far less than what the bank originally paid for them. On paper, the losses were enormous. For a while, those losses remained mostly hidden because accounting rules allowed the bank to classify many of its bonds as held to maturity. That meant the bank did not have to immediately report the decline in market value on its balance sheet. But financial markets have a way of exposing hidden risks. In early March 2023, word began circulating among venture capital investors that Silicon Valley Bank might need to raise additional capital to stabilize its finances. Those concerns spread rapidly through investor networks and social media. Within hours, something extraordinary happened. Major venture capital firms began advising the companies they funded to move their deposits out of the bank immediately. Those messages spread through text threads, emails, and private chat groups at lightning speed. And suddenly thousands of companies tried to withdraw their money at the same time. In a single day, depositors attempted to withdraw an astonishing $42 billion from Silicon Valley Bank. That number alone was enough to overwhelm the bank's available liquidity. It simply did not have enough immediately accessible funds to meet that volume of withdrawal requests. Within 48 hours, the bank collapsed. Regulators stepped in and took control of the institution. For thousands of businesses and individuals who had funds deposited there, the experience was deeply unsettling. One day, their bank appeared stable and fully operational. The next day, it no longer existed as an independent institution. Now, in this particular case, the federal government ultimately stepped in and guaranteed all deposits, even those exceeding the typical FDIC insurance limits. That decision helped stabilize the broader financial system and prevented panic from spreading further. But the speed of the collapse revealed something extremely important. In the modern digital era, bank runs can happen with breathtaking speed. There were no long lines outside bank branches. There were no weeks of rumors spreading slowly through communities. Instead, billions of dollars moved electronically through online banking systems within hours. What once took weeks now happened in a single day. And that brings us to a larger issue that many financial experts believe is quietly sitting beneath the surface of the entire banking system. When interest rates rose rapidly in recent years, banks across the country experienced the same basic problem Silicon Valley Bank faced. During the years when rates were extremely low, banks bought enormous amounts of long-term bonds and issued long-term loans. When interest rates rise quickly, the market value of those older assets falls. According to various financial estimates, banks across the United States are currently holding hundreds of billions of dollars in unrealized losses on their balance sheets. Some estimates place the figure somewhere between $600 billion and $700 billion. Now, it's important to understand that unrealized losses does not necessarily mean those banks are on the verge of failure. Many of those assets may eventually recover value if held long enough. But the losses are real in the sense that if banks were forced to sell those assets quickly to meet large withdrawal demands, they could be forced to accept much lower prices. In other words, the system remains stable as long as confidence remains stable. As long as depositors believe their banks are safe, withdrawals happen gradually and banks can manage their liquidity normally. But if confidence were to suddenly deteriorate, if depositors across multiple institutions began withdrawing funds rapidly, the pressure on bank balance sheets could increase very quickly. And because banking today operates almost entirely through digital systems, the pace at which funds can move has accelerated dramatically. Money can leave a bank with a few taps on a phone. Large investors can transfer millions of dollars instantly. Social media can spread fear or reassurance within minutes. This new environment has fundamentally changed how financial stress spreads through the system. Regulators and central banks are well aware of this shift, and they have developed various emergency tools designed to provide liquidity to banks if needed. But even with those safeguards in place, the basic structure of banking still relies heavily on trust. When people trust that their deposits are safe and accessible, the system functions smoothly. When that trust begins to weaken, pressure can build quickly, which is why experienced investors and financial observers pay very close attention to early warning signs, signals that may indicate stress developing beneath the surface of the financial system. Because long before restrictions are ever announced, there are usually clues. And in the next section, we're going to look at the specific warning signs that often appear before serious banking stress begins to unfold.